Good day and welcome to the presentation by Group 5 entitled The Subprime Crisis. Your presenters for today include myself, Devashalan Pillai, Shreyaska Naidu, Drayam Gopal, Dindakushla Lishaba, Ricardo Padiachi, Keegan Naidu, and Namishka Rambaran. So let's get straight into it. The subprime crisis is more commonly known to us as the 2008 and 2009 financial crisis. This is associated with deteriorating market conditions, illiquidity, as well as extreme losses that many firms have encountered. So the subprime crisis stems from the word the prime rate, which is the lower interest rate given to businesses due to their higher credit rating. Thus, the subprime rate will be referred to as the higher interest rate given to these businesses due to their lower credit rating and higher risk. This presentation is going to explore the impact that which securitization had on the financial crisis due to their reckless lending practices. Furthermore, the role that which the shadow banking industry played is going to be explored. Lastly, in order to prevent a similar crisis from occurring in future, improved regulations are continuously going to be needed with improved focus on corporate governance in the global economy.
The subprime financial crisis is deemed to be one of the worst financial crises to hit the United States since the Great Depression in the 1930s. Prior to this, however, market conditions were fairly favorable in that the economy could be characterized with low inflation, interest, as well as unemployment rates, and further to this, great and strong economic growth. This led many property owners and real estate investors to believe that property prices would continue to increase, and therefore they increased their borrowings. The low interest rate coupled with investors' expectations led to many lenders offering home loans to people with very bad credit. Eventually, debt as a percentage of disposable income increased from 80% in 1993 to 130% in 2006. These risky borrowings were used by individuals to make short-term profits by purchasing, renovating, and selling their properties. This led to many arrangements of individuals with high default risk obtaining subprime mortgages. The magnitude of these arrangements were fairly underestimated, and this is what led to the housing market crash in 2008. The decrease of property prices meant that many individuals were unable to make payments on their mortgages. This resulted in the repossession of many properties, and thus individuals and investors were impacted negatively by their properties being sold at a loss. Because of the integration of financial markets, this meant that not only the US stock market, but stock markets around the world were impacted negatively by this. Therefore, this led to the global financial crisis and the Great Recession of 2008. The Great Recession led to had shed light on phenomena like shadow banking as well as securitization. My group members will now discuss this further.
Securitization can be defined as a conversion of an asset into a marketable security, done so with the intention of selling that security to raise funds. It is a mechanism popularized in the 1970s residential mortgage industry and has had an astounding impact on essentially every type of debt instrument and credit market. There are two conditions that need to be met to ensure safe and efficient securitization. The first being implementing a robust financial structure to transfer the asset from the bank to the SPV. The second condition involves creating a strong investor demand to reduce transaction costs. An SPV, or special purpose vehicle, is a subsidiary to a parent company developed with the intention of assuming financial risk. Given that it is considered a separate legal entity in the eyes of the law, it has a separate set of financial documents, allowing the parent company to assume more risk without significant detriment to its own investors. The benefit of securitization and utilizing SPVs is alluring, as it allows for assets such as loans to no longer reflect in the company's financials, however provides them with cash to fund new projects. It could possibly allow for companies to acquire financing at a lower cost, particularly if said company's credit history is not favorable. With regards to the subprime crisis, lenders would focus more on the securities than they would on the insolvency status of the prospective borrower. As a result, banks experience a decrease in liquidity as borrowers will default on their payments. This is also crucial for financial mortgage portfolios, as payments for loans and mortgages are used as collateral for many different securities. Furthermore, securities can be inherently problematic. There is a risk of incorrect assets being securitized, or that there may be insolvency issues with the securities financed by mortgages. One metric used to assess the impact of the crisis on South Africa would be looking at the volume of securitization transactions. Securitization was first utilized in 1989, but only gained traction in 1999 when the first large securitization transaction was conducted by SA Home Loans to the value of 1.25 billion rands. By 2007, the value exceeded 30 billion rand. When the financial crisis hit, the value fell significantly to about 2 billion rand. That being said, South African economy was not significantly affected by the crisis relative to many parts of the world, as outlined by a study conducted by Vongai Madubeko of the University of Fort Hare, and this is supported by other existing studies in the literature.
A shadow bank is an entity that performs bank-like activities, such as providing loans to consumers. Shadow banks originated in the 1950s, and examples of shadow banks are investment banks, hedge funds, issuers of mortgage-backed securities, and parts of commercial banks that are not subject to regulatory requirements of commercial banks. And this is because shadow banks raise money from outside investors rather from normal bank depositors. In order to define the role of shadow banks during the financial crisis, we need to first examine the role of shadow banks in the financial system during the early 2000s. Shadow banks provided loans to consumers at a lower rate than commercial banks. Therefore, by 2007, the credit system had been owned by the shadow banks. Shadow banks then took these loans and sold them to investors as securitized financial instruments. These became very attractive to investors, and therefore shadow banks started to issue loans to high-risk people. These became known as subprime loans. Although the risk of default was higher, these were still AAA rated. However, as the interest rates went higher, investors became skeptical of the high rates of defaults. This is because the higher rate of default would result in an increased supply inside the housing market, which would decrease the prices of the assets. Therefore, this would make the underlying assets of the mortgage-backed securities worthless. This therefore froze the repo market as the lenders refused to accept mortgage-backed securities as collateral. Therefore, shadow banks lacked the funds to continue their operations because of the default rate and also the investor aversion. With regards to shadow banking in South Africa, if an entity wants to issue loans or other types of credit facilities, they are required to comply with the NCA. Therefore, shadow banking has had very small influence on the overall financial system in South Africa.
This section will outline the prevention measures taken since the 07-08 global financial crisis. The first is the International Financial Architecture, which refers to a group of organizations that influences worldwide financial developments and whose responsibility is to maintain the stability of the global financial system. The G7 is part of the IFA and is the main organization and contains 7 of the most economically developed nations in the world. After the events of the 07-08 financial crisis, the IFA had decided to expand the G7 into G20. Since then, the actions of G20 has been very effective. Some of these include the formation of the Financial Stability Board, which was formed in order to identify potential market weaknesses and prevent potential crises by recommending specific policies. Furthermore, they introduced stricter disclosure and reporting standards for certain financial institutions, especially hedge funds. These policies have aided the financial system to become more and more integrated and efficient and eventually perform better.
The Bank for International Settlements is a global financial institution which is essentially a bank for central banks. The BIS allowed for the establishment of the Basel Committee on Banking Supervision in 1974 in response to a period of major disruptions in international currency and banking markets. The committee aims to enhance understanding of key supervisory issues and improve the quality of banking supervisions worldwide. Basel I focuses on credit risk and risk-weighted assets and the capital adequacy ratio. The bank must hold 8% of its determined risk profile in risk-weighted assets. Basel II was published in 2004 and brought about 3 Basel regulation pillars concerned with minimum capital requirements, supervisory review, and market discipline. After the subprime crisis, it was clear that changes needed to be made in the international banking system. So in 2018, Basel III was introduced, which builds on the frameworks of previous iterations and was one of the BCBS's responses to the 2008 financial crisis. Funding liquidity was observed to be one of the root causes of the financial crisis. Two new measures were introduced under Basel III, which are the liquidity coverage ratio and the net stable funding ratio. The LCR ensures that banks have sufficient liquid reserves to cover net cash flows over a 30-day period. The NSFR is a ratio of accessible stable funding to required stable funding and aims at decreasing the probability of bank failure by solidifying the bank's liquidity position. The response of the US government to financial crises were bailouts, which enabled further expansion that ultimately resulted in more crises and more government bailouts. This cycle was unsustainable. The US Congress responded with the Dodd-Frank Wall Street Reform and Consumer Protection Act, known as the Dodd-Frank Act in 2009. This act aims to improve fiscal stability, manage risk, and limit the damage of crises, and also allows for the creation of federal agencies to enhance consumer protection. The Financial Stability Oversight Council monitors large companies whose failure would negatively impact the US economy. Two key provisions are the Consumer Financial Protection Bureau, which works with regulators in large banks to prevent risky business practices that ultimately hurt consumers. The other is the Volcker Rule, which aims to prevent risky trades and it limits banks' investments in private equity funds and hedge funds.
The impact of the subprime crisis on South Africa was severe, however, at the same time minimal when being compared to the damage incurred by other countries. The crisis was the cause of South Africa having a recession in 2008 to 2009 for the first time in 17 years, with nearly 1 million jobs lost in 2009 alone. South Africa, however, has foreign exchange restrictions, a sound regulatory framework, well-regulated institutions, and solid macroeconomic policies in place, which served as a barrier of protection for the country. Monetary and fiscal policies, low external debt, and a flexible exchange rate aided this barrier of protection and saved the South African economy from complete disarray. The housing, mining, and financial sector in particular was hit substantially. When looking at the housing market, the crisis triggered an increase in housing prices, which was then followed by a sharp decrease. In an attempt to eliminate this issue and decrease the losses incurred, the banking sector was forced into financing housing. The expansion of the South African economy at the time alleviated the impact of the financial crisis significantly. The second sector looked at is the mining sector. Due to the decrease in international demand, the production of South Africa's mining industry decreased substantially, in turn causing the revenue generated from diamond sales to decrease. The disarray in the mining sector resulted in macroeconomic variables such as GDP, employment, and export earnings being negatively impacted. The last sector examined happens to be the sector the most detrimentally affected, the financial sector. The productivity and efficiency of the banking sector from 2000 to 2010 deteriorated drastically. This decrease in total factor productivity, however, was owing mainly to the increased unemployment rate during this time. Other markets within the financial sector, such as the capital market, was also negatively impacted during this time due to it being increasingly volatile as a result of the fluctuations in share volumes. The impact on all these sectors combined is what led to the recession experienced in 2008 to 2009. It wasn't only until the last quarter in 2009 that South Africa finally saw the light of positive growth again. The shock brought by the crisis to South Africa led to the country introducing further legislative action in an effort to prevent financial instability and to protect the country from international financial disasters in the future. This involved a shift to the Twins Peak model. This model was initiated by the financial regulation sector, which provides the legal basis for the Twins Peak regulatory system of financial regulation. The Twins Peak model has been implemented in South Africa on the 1st of April 2018 and since then has solved the challenges associated with sector-based regulators and systematic stability. This model aims to maintain and promote consumer protection and financial stability. The model fulfills its objectives through a new prudential regulator, namely the Prudential Authority, which is tasked with overseeing the system-wide safety and soundness of financial institutions.
Overall, it is quite clear that the subprime crisis had a significant impact on the global economy and not just in the United States, as well as on the millions of lives due to the high unemployment rate that is associated with it. It is quite clear that securitization had a significant role in this subprime crisis due to the collapse of the housing industry in the United States. Furthermore, the impact that which shadow banking had on the subprime crisis was quite significant due to the close connection to securitization as well as the high liquidity risk associated with them. It is quite clear that more stricter regulations were needed. Thus was born the Financial Stability Board, Basel III, the Dodd-Frank Wall Street Reform, the Twin Peaks model which was specific to South Africa, as well as the Consumer Protection Act. Going into the future, improved corporate governance is going to be key to preventing a similar crisis from occurring. This can be established through increased transparency by businesses, accountability for all of their actions, as well as moral integrity from all the participants involved. This will simultaneously provide enhanced consumer protection, which is quite integral. In other words, better ethics is needed going into the future to establish improved efficiency and effectiveness, thus establishing best business practices throughout the global economy. And that brings us to the end of our presentation on the subprime crisis. We do hope that we were able to supplement your knowledge on this important concept in finance, and please do feel free to ask us questions at the end.